Lane, welcome to the show, man. How does it feel to be Lane today? You tell me it's a little like Christmas morning this morning, huh?
Yeah, it's recording this in mid-September. Supposedly the Fed is finally supposed to drop rates. Everybody thought it was going to be in July, but I think the Fed is taking more of a approach where they take a look at the inflation numbers and unemployment numbers, and right now it's kind of touching 2.5, which is where it's been for quite a while now. But I think unemployment is kind of popping its
Yeah.
head up, getting into that 100,000 a month job creation. So I think it's finally time that the Fed is looking to give up some of that dry powder is the way I look at it. Dry powder in terms of ways of stimulating the economy. So it's time to start doing it. And as real estate investors, a big part of real estate is getting interest, good loans, and interest rates is a huge part of it. Some would say even 60-70% correlated with that.
Yeah, it's crazy and how those cycles go through and how one thing affects another thing. Very interesting to see. But before we get into all of that, Lane, let the listeners know a little bit about who you are and where you're at now.
Yeah, so we own a control a portfolio of over $2 billion of assets, mostly multifamily. We do a little bit of value add, cosmetic renovations. We do ground up development, and now we're getting into more private equity projects, buying businesses. But it's been at least a decade in the making. I started my career as an engineer. In 2007, I graduated college, saved up my money to buy a house to live in, because that's what I was all taught to do, right? We're all kind of brainwashed in a way to invest in traditional investments and buy a house to live in. And that's what I did in 2009. But because I was traveling all over for work for my construction engineering job at the time, I just rented it out because I was a young single dude back then. And I just started to, that was the start of it all. Started to realize, wow, this is cool. Getting this cash flow, tax benefits, and everything.
And what was the big change for you, Lane, then to go from, that single family world into the scaling piece? And I heard you say that it was a good foundation builder. The single family was kind of learning. Is that how you felt?
Yeah, I mean, I talk about this in my book, The Wealth Elevators. There's different floors to the wealth building journey. When I first started, I wasn't broke, right? Like, I think most of the books out there, Dave Ramsey, Susie Orman, Rich Dad, Poor Dad, they're all kind of written for lower net worth investors, which in my book we call the basement, right? People less than $250,000 net worth, or they make under $50,000 a year, right? Me as an engineer, I mean, engineers don't get paid that great, but I was making around six figures, and I was really good with my money. More importantly, most of the investors we interact with today save $50,000, $100,000 a year at least. Some of them spend a lot of money, some of them really frugal like myself, but at the end of the day, it's not what you make, it's more what you save in net and invest at the end of the day. But from 2007, when I graduated, to about 2015, 16, I want to say, is when I was going from $0 net worth to $1 million net worth, which is kind of a key indicator in terms of being now an accredited investor for the eyes of SEC. Now, you may make more than $200,000 a year, and that will qualify you as an accredited investor. But at this point, what I realize, yeah, single family homes are cool. And a lot of people, they talk about doing this buy rent rehab strategy with single family homes. But most times what I started to realize, and I started to realize this by interacting with other purely passive accredited investors, just haphazardly. I started to meet a few, started to go to the conferences, and I started to realize there was sort of a kind of hidden culture, hidden ecosystem of accredited investors kind of doing it this way, right? Where they were trading in their rental properties and going into syndications and private placements as a passive investor, and then also now branching off into real estate and other asset classes.
You're calling that depreciation, the loss in the syndications that you had basically piled up, you use that to offset the capital gains of when you sold your rentals, and that's what you're calling the lazy 1031, because you don't have to that time frame, whether it's 45 days before or 90 days before, 90 days after. You don't, an attorney like doing all this stuff. This lazy 1031 is taking these steps, what sound like the wealth building steps, where you've got these single families, and then you go into syndications, building up that depreciation from those cost segs, and then selling the single families, using those active losses to offset the depreciation recapture.
Thanks for reiterating that. It's a little confusing, and obviously I'm pretty passionate about this, right? Because it's something that I do, and a lot of other folks do out there. Obviously not a CPA or tax attorney. People want a referral to a good one, they can let me know. But yeah, it's kind of like the old Indiana Jones swapping out the ark for the sandbag thing, right? So like the way I did it is like I had gotten the losses the year before, and then I went and did the swap in a way. You can also do it in the same year, right? Like, but I think that's a little ballsy, especially if you're looking at a huge capital gain of several $100,000 and above. Just like, goodness, if you have money, you have some money to invest in the deals first to kind of prime the pump, I would say. But you don't need to get any like attorney involved or custodian like a 1031 exchange. That's why it's kind of called the lazy 1031 exchange. When you invest, especially in real estate, you get passive losses, right, from the depreciation. And if you invest in deals where they're doing a cost segregation, you get a boatload of these losses, often more than you can use. When you talk with guys under $1 million net worth, they don't really have anything to lose, right? Doctors, dentists, high net worth individuals, you got something to lose. You got a big target on your back. This is why it's the transition to being a passive investor, where your limited partner is kind of the more transition, the way what I saw. A lot of this, like I thought rental properties was the way to financial freedom and is part of the way. But at some point there's a pivot point, and this is kind of where I brought into my book this wealth elevator system, where at some point, some threshold, and I would probably say once you're an accredited investor, you kind of get out of direct property ownership and transition to syndications and private placements on the second and third floor of the wealth elevator.
We've got these properties, Lane, that, in something I've heard recently, and I've heard it murmured before in the political world, but being taxed on unrealized gain. What do you think about that?
I don't think it'll ever happen. I mean, it's super messed up if you kind of think about it, right? Like, since
it's really messed up.
Yeah, I mean, like, I may look young, but I've been through quite a bit, and I see all kinds of like knee-jerk kind of clickbaity type of things like this pop up. Like, they're gonna get rid of bonus depreciation. What was the other one? They're gonna get rid of Roth IRAs. And that's why solo 401ks are a little bit more superior. Like, this stuff never really comes to fruition, especially more extremist things like this. And when you become an accredited investor, it's important to find a community of like-minded accredited investors flocking in the same direction, because very quietly, like there was another thing that they were going to tax the ultra wealthy, right? But then they correlate it with taxing your income. Dude, guys, it's not about your income, or it's not about your net worth. It's about, like, they're taxing income. So get smart and lower your adjusted gross income. And these are the sort of the strategies that people use. They have all their money as passive income so that they can use these passive losses to get it down to nothing. Now, a lot of folks starting out, a lot of new clients that I have, they have a problem of high ordinary income. The problem with ordinary income is you can't use passive losses to negate it. But you could possibly do real estate professional status as another option, right, to lower